Hey everybody, Smart Silver Stacker here. Last week, Bank of America issued a warning about a potential recession shock in the US economy. And right now, there are a number of factors in the world and in the economy that, taken individually, would not be great for the economy, but as a whole, they could really create some serious pain. And that's what we're going to be talking about in this video. Also, how all of those various economic factors could affect gold and silver, and some ways that I think stackers could be positioning themselves to take advantage of any potential economic pullback or recession. So, let's get to it. Today's video is brought to you by Silver Botanicals, personal hygiene and household products that utilize the power of nano silver. Head on over to silverbotanicals.com today and check them out. There's a link down in the description. And don't forget to use coupon code STACKER to save 10% off your order. Okay, so here's that headline where we saw Bank of America warning of a recession shock. This is from last week on April 8th. And if we take a look just at a little bit of this article, inflation shock worsening, rate shocks just beginning, recession shock coming. Bank of America Chief Investment Strategist Michael Hartnett wrote in a note to clients, adding that in this context, cash, volatility, commodities, and cryptocurrencies could outperform bonds and stocks. And there are absolutely a number of factors right now which could weigh on the global economy moving forward, not the least of which is the lockdown that China is currently experiencing after one of their worst outbreaks this year. And they've got this zero tolerance policy of the virus, so they are locking a lot of stuff down over there right now. And despite that, the case numbers are still rising. So we may see some very serious supply chain disruptions from China. And of course, China is extremely important in supply chains as they manufacture a lot of components that go into other things around the world. So, this is just going to be driving prices much higher, and it's going to compound the inflation problem that we are currently experiencing. And that is definitely not good for the economy. And another factor that could be weighing on the economy is the Fed's turnaround and the fact that they are raising interest rates now. But one interesting aspect of that whole thing is headlines like this. Here's Charles Evans. He's the Chicago Fed president. He says that there's a good possibility of a 50 basis point increase in May and that this won't cause a recession. But the thing is that this guy is considered more hawkish than the rest by calling for the possibility of a 50 basis point rate increase. And keep in mind that we just saw year over year inflation at 8.5%. That's a 1% move up from the 7.5% number from February. They're talking about every couple months maybe increasing the federal funds rate by half of a percentage point. And these are the hawks. We've got inflation moving up every month by 0.5% or 1%. And, in that context, there's no way that even a 50 basis point increase is going to help the Fed get ahead of inflation. And yet this guy is considered hawkish. And we see that language reiterated in several of these headlines. Like, here we go. New Zealand Central Bank hikes rates by hefty 50 basis points as inflation worries grow. So now we're talking about a half of a percentage point being a hefty move up. And here's another one. Bank of Canada due for oversized 50 basis point interest rate hike. Here's another one. Traders bet on an aggressive Fed. So more than the actual headlines, yes, the Fed raising interest rates could result in recession, absolutely. It's happened in the past when they've tried to raise rates. When they tried to raise rates back in 2018, they basically started to trigger a crisis in the repo market. And we're going to talk more about that here in just a minute. The real thing I want to point out is just the language in all of these headlines and how being painted that these small moves up of 25 basis points, 50 basis points, these are aggressive moves by the Fed, and that they aren't. In 1979, when Paul Volcker moved to tame inflation, that was an aggressive move. He moved the federal funds rate up to almost 20% in one shot. So that was an aggressive move. But I think that narrative is interesting, and it's indicative of the mainstream view on inflation and what it's going to take to get inflation under control. And here's another factor that could be weighing on the U.S. economy moving forward. This is that the Fed has announced that it is going to begin shrinking its balance sheet by as much as $95 billion a month. That actually is pretty aggressive for the Fed. Now, I don't think they're going to really be able to achieve this for any length of time without triggering some kind of a crisis. And you can see here on this long-term chart of the Fed balance sheet that they really started expanding this back in the 2008 financial crisis with the first rounds of quantitative easing. We've seen several rounds of quantitative easing since then. You can see that they did try to begin shrinking the balance sheet here back in 2018, but that didn't last for long because within basically 1 year, in September of 2019, they triggered a crisis where rates in the repo market started to spike up to around 10%, and they began purchasing assets again. And then, of course, in 2020, we know what happened then, and there was a massive increase in the Fed's balance sheet when they came out with just an absolute surge of liquidity and quantitative easing. And it's been marching up ever since then. And this is one of the biggest factors in the so-called economic recovery, is that the Fed has been out there purchasing treasuries. They've been keeping interest rates suppressed through these asset purchases. And now, if they begin to sell treasuries, for example, instead of helping to drive interest rates down and helping to take treasuries off the government's hands, instead now they're going to be a competitor. They're going to be selling treasuries onto the market in order to shrink their balance sheet. They're going to be driving interest rates higher. I mean, that is just the price that they're going to have to pay. And they're going to find out, I think, that that is unsustainable in pretty short order. I don't know what kind of a crisis is going to result from this, but something's going to happen. I don't think we're going to have to wait too long. Here's another indicator that a recession may be on the horizon. That was the yield curve inversion that we saw at the end of March, where the yield on a 2-year treasury went above the yield of a 10-year treasury. Now, that yield curve inversion has normalized since then, but the fact that it did invert could be a potentially bearish indicator moving forward. Here's a long-term chart of the spread between the 10-year and the 2-year treasury. And basically this red line here, every time this blue line dips beneath that, that is a yield curve inversion. And then the gray spots on the chart are recessions. So you can see that even going back to 1989, we had a yield curve inversion. And then in 1990, there was a recession. You got one in 2000, and then we had a recession in 2001. We got a yield curve inversion in 2006, and we know what happened in 2008. And then there was a yield curve inversion. It didn't quite invert, but basically they went to parity, and the blue line touched the red line here. And that was in 2019 in September when we had that repo crisis, and we know what happened in 2020. We got a massive recession. Now we saw this touch the line again. So, basically the same situation as all of these previous recessions. Now, this doesn't mean that we're going to have a recession tomorrow. As you can see from this chart, there is some lag between when you get the yield curve inversion and a recession, but it's definitely an ominous sign moving forward. But one thing that will be different about this recession or this economic pullback, if we get one, compared to the other ones that you see on this chart, is that this pullback is going to be occurring against a backdrop of extremely high inflation. So, in the past, when we've seen these sell-offs in assets, we've seen metals kind of march lower along with everything else. Now, will we see that this time around? I'm not sure, because inflation at 8.5%, of course, that's just the official number. The actual inflation numbers, I believe, are much higher. We may see investors a little bit more hesitant to sell off their precious metals, because that's what happens. Folks need liquidity during recessions, during pullbacks. They get margin called, everybody's levered up, so they end up just selling everything, and metals kind of tank along with everything else. Now, we might see that happen again, and if we do, I think if we see a recession, it's probably likely metals will pull back along with other assets. And if we see that, what I would be looking for is some deals in assets like the miners, maybe looking at indexes like the GDX and the GDXJ, because if those paper assets drop, I think that there will be some serious opportunities there. I expect that, the Fed is going to unleash a deluge of liquidity if we do see a pullback in asset prices, and asset prices are going to get pumped way back up, and precious metals at that point will really take off. So, I do think it's a good idea to have some cash on hand just in case some opportunities like that present themselves. However, I don't think that there's going to be a lot of opportunities to stack physical metal if we do see some kind of a spike down in the paper price, because even if, say, the spot price of silver drops to $10 or $12, there's no way you're going to be able to find silver bullion available for that price, but you might be able to get some deals on the miners, things like that. Of course, none of this is investment advice. I'm just kind of giving you guys my thoughts on what might occur should we see a recession and a sell-off in assets and some kind of an economic pullback. I think that the time to buy metals is right now. I know premiums are a little bit higher. Basically, I'm just looking around right now for products with a lower premium, maybe 100-ounce bar, kilo bars, that sort of thing. As far as stacking goes, I think those are the best deals at the moment. I don't think you should be paying $40 for a Silver Eagle or anything like that. Although, if you disagree with me, let me know in the comments down below. But I think the way to play this is to have some cash on hand, have a core position of physical metals because they're not going to go on sale even if other assets do. There might be some deals in the paper precious metal space though, maybe on miners and things like that, assets that even at today's prices I think are undervalued, but if we do see a big sell-off, there might be some really, really big bargains there and the opportunity to make a significant profit. Of course, that's all risky too, paper assets in a time when we've got all of this massive money creation, and who knows how the Fed might intervene if we do get a big sell-off. Chances are it'll be in a bigger way than they've intervened in the past. And of course, in the past, the interventions have been massive. So, maybe they'll be coming into the market, directly buying stocks. I think that they'll definitely be doing whatever they can to keep the asset bubbles inflated, but that's going to mean a lot of fiat creation. So, I like having some physical precious metals on hand and some cash looking for opportunities. But let me know what you think in the comments down below. And if you enjoyed this video and you'd like to see more like it, then check out the videos that are popping up on your screen right now. Thank you all very much for watching. I will catch you next time. Smart Silver Stacker, out.